Hey Josh, how's it going today?
Pretty good. So welcome back, everyone, to the Beat the Odds at Wealth podcast. So, Trevor, you're back in the office, and I am not still. So, so
Back, yeah, back in the office. Been back for a week. It's been good. The trip to the U.S. was awesome. Got to see things that never saw before. Where are you hanging out today?
I'm at the Pacific Rim, the Fairmont Pacific Rim in Vancouver. This is kind of my home away from home when I'm doing my Vancouver meetings. Once every 3 months, come down here, work in the Vancouver office, and hang out here. So, um, yeah, nice place.
Awesome. So, what are we talking about today?
Today we're talking about, has Canadian real estate bottomed? Okay. Because, whether you're, a first time buyer or you're an investor, you might be wondering, like, is now the time to get into the market, right? So yeah, so I'd really like to get into it. Trevor, we had a post. We usually do our
Okay.
national real estate post every month with the returns on Canadian real estate and the aggregate price performance. I
All
want to pull
right.
up the price map.
Sure. I
And
should be sharing now. And real estate prices, PEI, is that the one?
we want to go all the way down to the national price map.
All right.
Yeah, map of Canada, and I'll have the prices of all the provinces.
Okay. Oh, there we go. This one here? Yes.
There we go.
All right.
So when I say, has real estate bottomed, it's funny, but a lot of people might there's call it a third of the country who's confused by that title, and two-thirds of the country who's really interested in wanting to know the answer to that title. And and the reason is because you can see that BC and Ontario are responsible for most of the red. If we exclude the massive populace of PEI for a second, and most of Canada is geographically is experiencing price increases by a significant amount, but the bleeding red in the two very populous provinces of Ontario and BC are going down. And so that might be hard for people who live in kind of the center of the universe in Toronto type of thing, thinking that prices are up big in Alberta, Saskatchewan, even Manitoba. And so the question is, like, have the prices bottomed? Okay, so first of all, most people, like, if you're trying to build wealth, the focus of this podcast is you're trying to build wealth in Canada. Most people are going to overestimate the timing in the market of anything, whether that's stocks, whether that's real estate, whether that's gold, whether that's Bitcoin, and they're going to underestimate the time in the market. Okay, even if we're looking at Ontario, Trevor, what's that aggregate red number there right now? That 1.7%, right?
Yeah, so the number is 838K, down 1.7% from last July.
Okay, so let's say that you bought last July and now you're down 1.7% sitting there. Okay, so you're down 1.7%. What was your alternative? Your alternative was to rent. Now, do you think you were going to rent that $800,000 place for 2% of the purchase price? That's just was not going to happen. You were going to blow through that anyways in rent. Okay. And so most people are going to dramatically overestimate uh, timing the market. Okay. And they don't realize that the price of real estate is very interest rate sensitive. Okay. So you could buy the same place, that same $800,000 place, and we're looking at prime rates today of 6.7%. If the prime rates were the historical average of 4.2%, the price of that property is now $1 million property. Nothing has happened, in the demographics, nothing has happened to the value of that, the inherent value of that property. It's just that people buy based on the payments and what they can afford. Okay. So when you're buying in a high interest rate environment, you are sacrificing the amount of interest that you're going to pay in the medium term. Okay. But the price lasts forever. So when you purchase a property, it's like that is the purchase price. Okay. There's no there's no backing out of that. But every 5 years, you're going to renew your mortgage. And if you're on a variable product, it's is renewing all the time. So I I think a lot of people they get the one of the best pieces of advice I can give people is like you need to actually get off the sidelines sooner rather than later. Okay. Because rent is something that is, it's going up forever. Your rent is going up forever. And I see a lot of comparisons online saying this is my price to rent and this is my price to buy. Okay. But what they don't tell you is when you buy, that mortgage payment is now your new payment. Yeah, your property tax might go up. There might be some repairs and stuff that go up, but for the most part, the mortgage payment is the largest component of that home ownership equation.
Right.
And that mortgage payment is now, for the most part, let's call it, it's locked in for 25 years. Now, I know, rates reset, people's mortgages reset every 5 years. You can have a variable rate, but at this point, the likely scenario is they're not just locked in, they're actually going down because you're buying at 6.7% prime rate, with the historical average being 4.2% if you're looking back a couple of decades. Okay, so the likely scenario is that's going down. Now, what's happening to your rent prices simultaneously is that's going up. Okay, price of real estate in Canada, historical average, it's hovering around 6%. Okay, eventually rent follows the purchase price. Okay, it can lag a little bit in a low interest rate environment, but eventually rent follows the purchase price. So you map that out. Okay, rule of 72. You take 72, you divide it by the percentage rate, you get how long it takes for that thing to compound and double. Okay, so 72 divided by 6, that means your rent is doubling every 12 years. Okay, follow it out again, another 12 years, it doubles again. And so we're talking about your rent. In 12 years, it'll be double. In 24 years, it'll be quadruple. And what has happened to your mortgage payment over the same time horizon? It has
It's gone
remained
down.
the same.
Yeah.
It has
And
remained the same. And in year 25, it's done if
yeah,
you
it's
stuck on a
finished.
25-year
Yeah,
amortization.
that's
Okay.
right.
And so most people, they're making very short-term financial decisions, assuming that they can time the market. Okay. And I always tell them, like, be very aware of the person that you're taking that advice from. If they're saying that they can time the market, have they sold their principal residence and got out? Because they haven't sold their principal residence and got out, they don't believe the bullshit that they're telling you. Okay. And so now that's not to say that people don't overbuy in the hysteria. Okay. So general rule of thumb that that we have for clients who are buying real estate is, have you looked at the 5-year comparisons in that neighborhood? 5-year comparisons. I want all of the 5-year comparisons in that neighborhood, or if it's a condo building, in that condo building. I want every single transaction. I want to know what it was per square foot. I want to know what was sold. Now, what will happen in an overheated market? These are the markets we're saying, well, hey, this listing just happened today. It's going to get sold in the next 24 hours in a multiple bid processes. They won't even you won't even be able to get that from the realtors. It's like that will protect you from those, the crazy times. Okay. Just doing regular due diligence will protect you from that. Okay. Sometimes even just putting regular, subject to financing, subject to inspection is going to prevent you from buying in crazy times. That's okay. Okay. But we're not in those times right now. Okay. So people are wondering, have they bottomed? If I'm to look at this on an aggregate basis, probably BC and Ontario. If I had to guess, I would say probably not yet, but it's very close. That would be my guess. Historically, home sales are weak heading into the fall. October is usually, the best month to buy in terms of like trying to get the best price, but there's no guarantee that that will be in every year. So if I was to speculate, they're probably close, but not there yet. We still have the massive influx of population, massive immigration coming in. And you've heard in the news, recently this week that they said, they're going to curb the immigration. But that's the very important point, is they're going to curb immigration So that means instead of letting in 1 million people, they're going to let in 250 or 500,000. It's still going up, people. There's no plan to reduce that population. Okay. And that's the whole, crux of it too. We talk about building money and wealth is, we talk about inflation. What happens is the goal is to trade your fake money, the fake paper dollars that get inflated away for real assets. Okay. But people sometimes think that inflation is going to go away. They're looking for the next election cycle where their guy is going to get elected and all of a sudden everything's going to be okay. Like, here's like the really hard truth that everybody has to wrap their head around is it's going up forever. The inflation is going up forever. It does not matter who you vote for. They have no plans to implement deflation. All they're trying to, they're the conservatives right now campaigning on, reducing inflation. But that's the key word. Listen to that very carefully. They're campaigning on reducing inflation. They're not campaigning on eliminating inflation and creating deflation. So the certainty is it does not matter who wins the next election, prices will be more expensive at the end of those 4 years than at the beginning. Okay. It's just some of them, the prices are going to go up faster, but they're going up. Okay. There's really no plans to create deflation. Okay. For whatever reason, all the central banks around the world have drank the John Maynard Keynes Kool-Aid, and we are all Keynesians, and they want inflation forever. And that's a whole other side topic. But the purpose of this discussion is how do we build wealth with real estate? Have those real estate prices bottomed?
Yeah. And another important point is, the wages aren't keeping pace with the rate of inflation. Even if it was at the 2% goal that the Bank of Canada is looking to stay at and keep the rate at, we know that the actual rate of inflation is 8%. So with wages not keeping pace with that, waiting to get into the market is just a bad choice, because not only is the money that you've got now, or what you perceive to have, the fake dollars, it's reducing your buying power is reducing by 8% per year. So, that is, for me, I think people should be getting into the market if they can at this point, even if it's just getting into a condo or apartment to get started on their real estate journey. I don't know what your thoughts are.
Yeah, I mean, I think, if I had to pick the aggregate bottom, but the aggregate bottom for BC and Ontario is somewhat irrelevant because you're not buying the average. You're buying one particular property in one neighborhood. Okay. So and if you're buying real estate, for those experienced in buying real estate, it's like if you want to buy today and you want to close tomorrow, you're not going to get a very good deal, no matter what market you buy in. Okay. You're going to have to shop around. You're going to have to find, just because you want the property doesn't mean the property that you want is available at that given time. You're going to have to submit offers. You're going to have to be prepared for those offers to get rejected. You're going to have to be prepared to go find a new property. You get emotionally attached to the property. That's when you start paying, per square foot prices that don't make any sense in that neighborhood. Okay. And so buying a property, as soon as someone says, I'm buying a property, it's like, to me, that's something that they're looking at doing in the next year. Like when I hear that, one of my clients is coming as I'm buying a property. It's like, I don't think you're going to buy a property tomorrow. I think you might buy a property, maybe there's a property that you could close on in 30 days, or maybe it's going to be 11, 12 months down the road. That's a realistic time frame. And so, when I look at, have the prices bottom, probably not yet, because 6.7% is very high, and the likely trend for interest rates is down slowly. That is the likely trend. The Bank of Canada meets 8 times per year. The likely trend for that is dropping by a quarter point each time. That means within the next year, they still would be, from 6.7 on a prime rate of interest to 4.7. It would still be 50 basis points over the average, okay, over the historical average. that's still pretty high. So going into the winter, I actually think probably if I'm projecting the aggregate bottoms, it's probably a couple months out. That's the likely scenario. Now there's always things that can happen, but no one's buying the average. You're buying one particular property for you to live in or for you to rent. Okay. And so if you actually thought that the aggregate balances, the aggregate um, lows were a couple months in the future, it's like you need to start looking now. Okay.
Mhm.
One of the objectives we give everyone in the boot camp is like you should have realtor.ca, downloaded to your phone. You should be looking all the time. You even if you just want to own property someday or you already own property now, you should know what the value of that real estate is. It's very important. For most people, it's going to be, for a lot of people, it's going to be their largest asset, and and they should know what it's worth, right? It's just an education tool, instead of, looking at, what the sports scores are, who has, who scored the most goals or who has the most RBIs. It's like, why don't you know what the real estate has done in your neighborhood? It's like, it might do a little more to add to your net worth if you actually know that. And so I would say we're probably right around the corner, and you can see we're probably right around the corner for the lows in Ontario or BC. And really, most of the rest of the country has already passed that bottom, because what happens with the migratory patterns is people generally come to Canada, they land in Ontario and BC, and then they migrate outward when they figure out that it's really damn expensive to live in those two provinces.
Yeah, and what we've been finding the last few months, we've been looking for a property is a couple of things, and also been working with clients on their mortgages. When they're looking for a property, if it's something that is like a reasonably priced property that most people could afford, it's going really quickly,
Mhm.
and there's multiple offers and whatnot. So those ones in like the 300, $400,000 range are going really quickly. One's the next level up in the $500,000 range. They stay on the market for a week, maybe 2 weeks, and then those go pending really quickly. It's when you get beyond that, like above the median price, that they're staying on the market for 50 days, 60 days, 120 days, coming off the market, going back on the market. So really in that sweet spot is where things are going on the market and they're being scooped up rather quickly, just because of affordability. And for me, I don't feel. I was actually talking with a real estate agent yesterday or the day before, and he knows that pricing is going to go up, but it's not going to be a massive jump. It's not going to be crazy, but it is always going up, because I mean it's just the fact of the matter. There's more migration, more people coming to Alberta. And with every new calendar year, there's like a 2, 3, 4% growth in the pricing of real estate in Alberta, and I don't see that changing. And I don't think that with whatever rate drops we're going to be seeing late in the fall or maybe next year, I don't see the prices jumping up dramatically. But still, I think people should look and become educated. Like just because we've been looking at Realtor.ca for so long, like 4 months, 6 months now, you can see the patterns, you can see the neighborhoods, you can see what prices are in range and which ones are out to lunch. And it just really helps you kind of build almost that muscle memory as to what the prices should be and what you should offer. But I mean, for me, I'm never going to offer a list price for anything, simply because most buyers overestimate, or sorry, most sellers overestimate what their property is actually worth versus what the market actually will sell it for. So, what are your
Yeah,
2 cents on that?
yeah, it's important. Just don't get emotionally invested to any one property. And you did touch on something there, that luxury real estate tends to be more of the risk. When you start buying over the average price in a particular province, in a particular city, especially in a particular neighborhood, you run the risk that that becomes a much more liquid asset. Okay, now it can be a more high risk, high reward scenario too. When you're buying in the ultra premium neighborhoods, it can be something that's going to appreciate much quicker because it's more desirable. But you're also, venturing into an area that maybe it's not as desirable as you think. Right? And a lot of the horror stories you see online are like, kind of the far out in the suburbs, uh, GTA area where people thought this was the next up and coming neighborhood, and houses had sold for $1 million here, and all of a sudden they're selling for two, but they've only been selling for two for 6 months now, and people start paying that, right? Look at the 5-year comparatives of that. It's like that has to make sense. Okay, you want to be a real estate investor, not a real estate speculator. And if you're, if you have the money to be a real estate speculator, if you're putting 10% of your net worth into what you think is an up and coming neighborhood, that's that's something, right? But if you're putting 80% of your net worth into this one family home, that might be not the right way to proceed. Right? And so, the question being, has real estate bottomed? Probably not in Ontario and BC, but it's probably very close. Okay, it's probably very close to bottom. And if you were to start looking now, you're probably going to be around where the bottom's launching in now. And people have to realize is like, we think that we see the prices going up next year. Could there be some events that rattle it down? There could. If there was some sort of geopolitical event, if for whatever reason interest rates in the U.S. They had to hike interest, but I don't think that's the likely scenario. The probably a higher probability. When I mean a higher probability, I mean it's a higher probability than rates going up. But the higher probability is rates actually have to come down quicker than what we think. Or you start to see, if you see a 50 or 75 or 100 basis points move in the US, that will flow all the way through to Canada. That will mean prices will appreciate much quicker. So that tail end risk, there's always tail end risk that prices are going to decline even further than we expect. There's a tail end risk that prices could increase quicker than we can expect. This tail end risk is probably bigger, but both of them are probably proportionally small to the fact that probably bottoming towards the latter half of this year and then increasing into next year. But time in the market matters more. Okay, what is that? What is that rental cost that you would be paying, right? If you didn't enter now, right? You sign that next year 1 year lease. What is that going to be? Is that another 24,000 a rent, 36,000 a rent, another 48,000 a rent? What does even a 5%? Sometimes it's even if you had a 5% drop, you would break even on that price.
Yeah. And there's always nuance to this as well. Like, this isn't a channel where you take your, solid, investing advice and say, oh, because Josh said I'm going to do this. No, you got to do your homework and you have to look at the prices. You have to pay attention to the market. And, going back to what you said about if there was like a one full, 1 point drop in the interest rate in the US, not only would real estate asset prices grow, but all other asset prices would increase as well, right?
That's right. That's right. Yeah. That is the risk, right? And we saw how kind of fragile the system is, where we saw what happened with the Bank of Japan, and although it sounds, for the average Canadian, it's like, what the heck has the Bank of Japan got to do with Canada? It's like, how interconnected that was, for Japan basically had interest rates at 0 or even negative 0.1 for pretty much a decade. And then because of the decreasing price of the yen, they have to import their energy and other imports, that they decide to raise rates to strengthen the yen a little bit. They go from negative 0.1 to 0.1. Everything was, for the most part, okay. But then they went from 0.1 to a 1/4 point interest rate. And this is wild, right? We're talking a 1/4 point interest rates, where interest rates in North America were 5.5%. We're talking about the central bank rates, and the entire thing blew up. Okay, that blew up. The carry trade started to unwind. So the people who were borrowing money for very cheap rates in Japan and buying, international assets, primarily U.S. Treasuries, U.S. stocks, all of a sudden you see the massive sell-off. Bank of Japan comes out and says, hey, we're no longer going to increase rates with the market instability. the U.S. Federal Reserve says if we have to step in and fix it, we will. And just them saying we will cause the market prices to recover, right? So that means they would do it, right? And it was interesting that it was such a small percentage change. I think everybody could kind of project if Japan raised their interest rates that the carry trade would unwind, but probably the surprising part was it would unwind, with only a 0.25% central bank rate, right?
Yeah, well, it just
So
shows just how fragile the system is when you're relying on this fake fiat currency that they've created, right? The 20 billion Zimbabwe dollars versus
yes,
real assets like gold, Bitcoin, real estate, good dividend paying stocks.
exactly. And so when you're holding on to the cash, there is no risk solution, right? That is the the kind of the lie that's sold throughout the financial system is like there is a no risk solutions. Not really. You're basically you're banking that the cash that you're holding, or even if you're holding a money market fund or some treasuries, you're hoping that that actually does outperform real inflation. And that's not a solid bet year to year. It's like people might win that bet on a 1 year basis, but if you keep taking that bet year after year, you're going to lose that bet. Okay. That interest rate that you're getting in your money market fund is not going to outpace the real inflation, which right now, we teach people to calculate it in the boot camp, and we take it back with a number of examples and a number of assets, and taking it by gold, for example, which has been a store of value for 5,000 years, would tell us that it's 8%. Okay, not, and we're not talking 8% for the last year. We're talking 8% over 25 years, and so there is no risk-free solution. When you stay in cash, you risk having that cash devalued. Okay. And so you have to weigh the balance of risk. If you continually stay in cash or a money market fund or a treasury, that's going to get devalued through inflation over time versus what's the risk that I enter the real estate market now and I buy it at the, kind of at the tail end. How do I mitigate that risk? Okay. Well, I don't make stupid offers on speculative neighborhoods. I get 5 years of comparatives. I get my home inspection. If the market is, if that house is closing in a day and there are going to be multiple offers, it's like that's telling you that that one's overheated. Okay.
Yeah, just walk
And
away from that.
yeah, and
The
and that's how you start to make good choices.
Yeah, for sure. And
Uh,
another thing is, if a home is, overheated and it's going for too much, the banks can also trigger an assessment of that property, right? So, what is this property actually worth in the market? So, I mean, the bank won't lend money on something that, the value isn't there either, right? So an appraisal can be triggered as well.
True, and people are often surprised when there's especially in overheated markets. Sometimes that saves them from themselves because there might be 3 or 4 offers over top of a list price, and then the appraiser comes in and says that no, I think it's only worth the list price. And then guess what? The bank's going to lend on. They're going to lend based on the appraisal value. They're not
That's
going to
right.
lend on because they're not going to lend on what some unsophisticated real estate investor thinks that it's worth. They want to know what the professional appraiser thinks, right?
Yeah, it's all about
And
mitigating risk because banks are in the business of making money on these transactions, not losing money.
yeah, so maybe just pull up, Trevor, right after this. Let's pull up Alberta, and we'll just kind of show the stark contrasts between Alberta and Ontario.
All right, here's
Okay,
Alberta.
and you see, and Fort McMurray still has had they've had a long road since since the fire there. So, but for the most part, you're just seeing Alberta absolutely just cooking, and like when you start to see like Edmonton and Calgary 7, 8, 9%, like these aren't small cities. Like we post these all the time, but these are you might see wild numbers for like a Lethbridge or a Lloydminster or something like that. But
Mhm.
um, you know, you don't get, but they can be highly skewed by a couple of units because it's a relatively small population, and these are these are aggregate numbers. So a small number of units can really skew those averages. But when you see major cities over a million, Edmonton, Calgary, well over a million people moving by that amount, it's like that's not skewed data. That's just an absolute rocket ship of pricing. Okay. And so you're seeing that influx of population, basically migrating from Ontario and BC coming into Alberta. You're seeing that normalization. And conversely, if you bring up the Ontario listing, it's the sea of red.
All right, let's check it out. So Saskatchewan, I think, and
Oh, just past it. There was a cover page on it.
This one here?
Just below. Yeah, probably. I think so.
Oh, there we go.
There you go. Yep.
All right.
Just click through and you see the sea of red. And a lot of people would see that sea of red and say, I'm scared. I'm out of this thing. And they see Alberta. It's like, oh man, that's cooking. It's like, I would actually be more nervous buying in Alberta tomorrow than I would be in Ontario. Now, I'd be entering either. I always think there's deals in any real estate market, whether it's at the peak, whether it's at the mean point, or whether it's at the low. There's always a deal happening next month that's a great deal. The fact is that, can I find that deal? And so you start to see this absolute sea of red happening in Ontario. That shouldn't be a fear point. That should be a point where there's probably more deals there now. There's more distressed sellers happening there now, right? And the key with real estate is to have that long-term horizon, right? We always look at like, what's the percentage? The banks want to see people qualifying for mortgages based on 39% of their income. Okay, that's great. But also understand where your income is in the trajectory of your career. Okay, so let's take, pretend you're a plumber. Are you, the highest paid plumber on the crew? You're making $45, $50 an hour on this private plumbing company. Or are you a second year apprentice who's an all-star and you're rising and you're passing your course as well? So you have to understand, is like, am I close to the top of my income earning potential? Or is my income earning potential got a long room to grow? Because 39% is a somewhat arbitrary number. The banks have to do that because they can't evaluate everyone's career trajectory, but you can evaluate your career trajectory, and you can kind of understand, it's like, okay, is 39%, of my income today, going to be 20% of my income within a year or two? That's not that risky. Whereas the person who's buying right up to the limit of what they can afford, and they're working for a company that's slow and they might get laid off. And if they work for another company, maybe they're taking a bit of a pay cut. It's like 39% can be very, very risky. Okay. So it's a somewhat arbitrary number, and people need to overlay, what the stability and the growth trajectory of their income is going to be. But when I look at that, I see a lot of opportunities. Okay. There is going to be some house sold in Ontario next month that's, even though the average is likely to, the average price is likely to bottom sometime October, November, December. There's going to be a house sold next month that's going to make someone very, very rich because there's always a distressed seller. It's like, even in overheated markets, there's a distressed seller. There's someone who bought at the top of their income level. They've gotten laid off from the job. They overextended themselves. They're getting a divorce, and that price is just going to go for less than what it's worth. So when you see red, think opportunities.
Yeah, somewhat of a market correction out there in Ontario, because things were overheated there for a while. Same thing, because of the massive immigration, low number of homes on the market, and supply and demand. That's just economics 101. But looks like now, with the numbers that you're posting there's been somewhat of a correction in the market pricing out there. So hopefully, things will get less heated out there, and people will start being more realistic with the pricing, and something that folks can actually afford. I was following one guy on Twitter, and he was really outlaying that one of the major problems that we're having out there was people buying speculation of these condos. So they're pre-sales, condominium pre-sales in Ontario for, $1.2 million. And then now they're selling for like half of that, right? So, I mean, they're not able to close on that deal, which is causing some of the numbers that you're seeing there. But it's just, Ontario and those places are a lot different than most other places in Canada, right?
Yeah, yeah. If you just look at it, like they're literally double most of the rest of the country. Ontario and BC are just double the rest of the country, and so people, say Canadian real estate prices are extraordinarily high. It's like, oh, they're high in two places.
Yeah.
They're high in two places, and they're still relatively reasonable in most of the rest of the country comparatively. Not where we want. Certainly wages are not keeping pace with inflation. This is where people are, really finding that pain point. But for the most part, there's almost a tale of two countries almost into one when we look at real estate prices in Canada. So
For sure. Yeah, I just pulled up the Saskatchewan real estate prices here. Looks like in Lloydminster and Yorkton, there's a little bit of a change there, but you look everywhere else in Saskatchewan and their prices are going up as well. Kind of similar story to what's going on in Alberta.
yeah, yeah. I think that's what we have for this week, Trevor. So hopefully that gives someone the confidence out there to realize that your cash that you're sitting on, it's like that's definitely going down over time. It's like maybe it's time to get out there, start looking for some deals. Probably haven't seen the bottom yet, but there's certainly a deal happening tomorrow somewhere where you are.
Absolutely. And don't forget, folks, we do have our biannual beat the odds at beat the odds at Money and Wealth in Canada, and it's coming up in November. So if you haven't got your ticket yet, please go to spurrell.ca, click on the Business Bootcamp tab, and inquire. Get your tickets today. See you guys
Right
next
on.
time.
Bye bye.